Alright, welcome everybody. Today's video is going to be a bit different, as I'll be sharing a major financial decision I recently made that involves selling $40,000 worth of stock. Stick around to find out why I chose to do this and the strategic moves I'll be making for my portfolio in the future. But before we get to that, if you're new here, welcome to the After Hours channel. For those of you that don't know, my name is Anthony. I'm a long-term investor with a passion for money, stocks, and personal finance. On this channel, I'll be sharing my insights and experiences as I track the performance of my dividend portfolio. I believe in the power of long-term investing, and I want to show you what it's like to be a long-term investor in today's market. Whether you're just starting out on your investing journey or you're a seasoned pro, I hope to provide valuable information and resources that will help you make informed decisions about your money and investments. Join me as I share investment strategies, discuss current market trends, and provide tips and tricks for managing your personal finances. Subscribe to stay up to date with the latest from the After Hours channel, and let's build our wealth together. All right, everybody, glad to be back. I apologize for the long durations that I've been gone. I've had a lot going on recently that I'm not going to be able to get into, but I just want to say that I am back. I'm going to be trying to pump out as many videos as I can in the future, hopefully multiple a week. But as of right now, there have been some major changes with my portfolio. Kicking things off, this is going to be episode 15 of Road to 1 Million. If you're unfamiliar with what that is, I'll be tracking this portfolio that you see on your screen right here all the way to $1 million. Doing a quick little portfolio update for you guys because I know it's been a while. This is the all-time view. We can see that the portfolio since the beginning is up 46% or $28,000. If we take a look at the year-to-date view, we can see that the portfolio is up 41%, so $25,000. I am incredibly happy with that, and it's been a great year to say the least. As I mentioned, there was a lot of changes to my portfolio in terms of which companies I own, so if you want to see the updated list, you can see it on the right-hand side of your screen right here. Feel free to take a screenshot or pause the video to get a better look. But with that being said, we're going to dive into exactly why I sold $40,000 worth of stock. So, over the past year, the stock market has seen some interesting trends. Notably, tech giants like Microsoft and Apple have undergone significant changes, experiencing an overhaul that impacted their stock prices. Meanwhile, other companies in my portfolio remained relatively flat for the year, as you can see here. Now, while Microsoft and Apple are two cornerstones of my portfolio, they have definitely contributed to the gains this year more so than the rest. And now you're still probably wondering why I decided to sell $40,000 worth of stock. Well, the main reason was to address a pressing issue in my financial life, which was paying off debt. Prioritizing financial health is crucial, and in my case, reducing debt was a priority over waiting for certain stocks to potentially recover. It's all about finding the right balance for your individual circumstances. Now, as you can see on your screen right here, there's a few buys in here, but the majority are sales. This is the $40,000 worth of stock that I sold off, and we'll go through each one so you can take a look at them, and I'll briefly discuss why I sold that individual stock. Going down the list top to bottom, I actually just bought some more Visa, about $500 worth the other day, and I'll be putting another video out in the future talking about Visa and why I'm continuing buying it even at its current PE. After that, you'll see I sold $1,000, which was the remaining balance of my Schwab large cap ETF, which essentially its top holdings were Apple, Microsoft, Facebook, and a few others, so there was just a lot of redundancy in my portfolio, and I didn't feel like it was necessary to hold this anymore. Heading down the list, you'll see that I actually sold my entire position of Union Pacific. Taking a look at Union Pacific, we'll break down the financials real quick, and there may not be an immediate indicator as to why somebody would sell out of this company. I mean, they are earning free cash flow that has continually gone up year after year, but there are other key factors that I want to highlight. Taking a look at the valuation section, we can see that the PE of Union Pacific right now is about 20, which is pretty high for this company. And one of the most alarming issues that I see with this company in the future is their excessive debt. That's right. You see on hand they have $766 million, but they're in debt $30 billion. Which nets out to almost an even $30 billion worth of debt. Now, I don't know about you, but I really don't want to hold any more companies in my portfolio minus one that I'll talk about later as well, that has this much debt on hand. Additionally, if we look at the dividend section, we can see that they pay a 2.4% dividend, which in my opinion is pretty good. I have no problems with that, but their payout ratio is 50%. That is just a bit too high in my opinion, and something I don't feel as comfortable with. I want to own a company that can easily pay their dividend out with no issues and still have a remaining balance that they can use for R&D or to repay their shareholders. Taking a look at their revenue, it just looks like it is just plateauing over the last few years. It goes up, it goes down. It looks very cyclical. That's not something I want. EBITDA with this company looks very healthy in my opinion, and it's definitely one of the reasons I bought into it in the first place. Taking a look at their free cash flow, again, it resembles the EBITDA. Even though it's gone down from 2021 to 2022, it's still extremely healthy. This company is making money. But then you jump into their cash and debt ratio and you see this. Their debt is just consistently going up year after year, with 2022 being the highest debt they've ever had in the company's existence. If we take out capital leases, which is essentially rent for them, we can still see they have $31 billion worth of debt. And this little green bar down here at the bottom, that is their cash reserves. It has plateaued since 2002. It's not going up. Therefore, the executives at this company are not making decisions where they think they should have a significant amount of cash on hand. That is just not something I want to see as an investor right now. I'm not saying that this company is not a buy or it's not a good investment. It is just not a company that I want to hold anymore. It's not just about paying off debt. I'm taking this opportunity to high grade my portfolio. What does that mean? Essentially, I'm reevaluating and rebuilding my investments, focusing on companies that not only have high profitability, but also have minimal debts. It's all part of a strategy to create a more robust and resilient portfolio for the long term. Now, this portfolio typically has not had many stocks. It's probably been more concentrated than others, but if you look at it right now, I only have 5 holdings in this portfolio. That may be a little unnerving to some, but I am fully fine holding these companies as of right now, and I'll be buying into others in the future. But this is the starting point for the process of high grading this portfolio. So, what companies am I looking at now? I'm leaning towards those with a proven track record of profitability and sound financial management. By doing this, I'm aiming to reduce the risk and position myself more stable and consistent returns over the years. It's a proactive approach to investing that aligns with my long-term financial goals. A prime example of this is Visa. Visa, or ticker symbol V, is currently trading at $244 per share. This company is an absolute powerhouse, and in my opinion, it's still a buy. Some may look at the valuation and think it's overpriced right now with a PE of 30, but if you look at the historic PE of this company, it's always been around that 30, 25, or high 20s PE. It's very rare you're going to get this company at a discount, and you'll see why in a second. Doing the same thing we did with Union Pacific, let's take a look at the balance section. Taking a look at the balance section, just like we did with Union Pacific, we can see they have on hand $20 billion in cash, and they're also in debt $20 billion, which nets out to negative $335 million, which this company could easily pay off if it wanted to. Would I prefer that they had more cash on hand? Absolutely. But with the amount of free cash flow that this company is bringing in, they could easily stockpile cash whenever they want to. Taking a look at the dividend, we can see that it's 0.85, so on the lower end, but their payout ratio is only 22%. That's something I like to see. Taking a look at their revenue, we can see that it is going up every single year. It doesn't even look real at this point. Their revenue is like a rocket ship that they consistently raise every single year. But you don't only want to just look at the revenue. Let's take a look at their EBITDA. Same thing. It is consistently going up. There's not huge spikes, there's not huge dips, but it is just year after year like a step up and up and up. Great to see if you're an investor. Arguably one of the most, if not the most, financial metric to look at when you're valuing a company, and that's their free cash flow. And as you can see, Visa is bringing in a ton of cash. In 2023, the company made $19.7 billion. Let's factor in stock-based compensation, and we can see that out of that $19.7 billion, they paid their executives $765 million, which is nothing for this company. This is a great indication to look at to see if your companies, your holdings are diluting you as the shareholder. In this case, as far as their free cash flow and how much they pay their executives, that is not the case. We look at their net income, same thing, resembles the revenue. 2023, their net income, $17.27 billion. Taking a look at the cash versus debt ratio, we'll take capital leases out of it. We can see that Visa has always had a high balance of cash, and they've always had a relatively high balance of debt. Now, as I mentioned before, I would obviously prefer they do not have as much debt as they do cash on hand, but it does signify that this company could easily pay their debts off if they wanted to. This is a dividend portfolio, so we got to check out the dividend, and over the last 10 years, it has grown by 18%, which is huge. This is something that I love to see. Another indication to look at to see if your company is diluting you as the shareholder is take a look at their outstanding shares. Looks like since 2010, Visa has been buying back their own shares. This artificially increases the price of the stock. Therefore, my stock is worth more because they're buying back the outstanding shares. Taking a look at return on capital employed, we can see that Visa has historically had a pretty high return on capital employed. So last year, 2023, was 31%. The average company in the market does not have returns this high. They're often 10% or below. Jumping back to the recent trades, under Union Pacific, we got Visa. I bought $3,000 worth of Visa on November 5th. As I mentioned, this is a company I'll be buying for the foreseeable future until I feel like it is at its fair value. Next on the list, one of my holdings, Vici Properties. I bought an additional $1,000. And getting into some of the larger sales, we have Apple. I actually sold off $4,000 worth of my Apple holding. Taking a look at Apple real quick, I mean, this company is an absolute juggernaut. It's been doing so well this year, but the PE ratio is also at 30 right now. So I do think this company has hit its fair value, if not is overvalued at this point. If we take a look at the year-to-date performance, Apple is up nearly 50% on the year. So this company has done extremely well, which was another reason for me to trim some of that fat off and take some of my gains. Even with that sale, we can see that Apple still makes up a sizable amount of my portfolio. It's actually 25% of my portfolio is still with that sale. My current market value is $20,000 in this company, and you can see that I'm up 40% on it. Next on the list is probably my favorite company, and that is Microsoft. I sold $15,000 worth of this company. Now, before I take a look at the financials real quick and I show you guys how much I still own of this company, I still think this is a hold. I think this company is overvalued right now, but I do think it is a hold. My reason for selling this company had nothing to do with the financials, but it was more so that this company has performed so well for me over the last few years that its overall value was starting to take over the entire portfolio, where I think it was almost at 40% of my portfolio at one point. Checking out Microsoft, it is still 30% of my portfolio, and my market value for it's about $25,000. As of right now, I'm up 46% on this holding, even with a $15,000 sale. Now, as much as it pained me to sell this company, and believe me, it really did, I am just at a point in my life where I do not want to have any more debt. And if I do have debt, I wanted to make sure that the interest on that debt was low enough that I could easily outperform it with this dividend portfolio. Taking a look at the valuation real quick, Microsoft's currently trading at a 35, almost 36 PE, so that's pretty high in my opinion, even with the financials of this company. Jumping over to the balance section, we can see Microsoft has $102 billion in cash. I mean, that is just insane. And as far as dividend goes, 0.81, and their payout ratio is 27%, so very low. Heading down the list a little bit more, sold off another large portion of Schwab's large cap growth ETF. It's about $6,500 worth for reasons I stated earlier. After that, I made the decision that Berkshire Hathaway, while a great company, one of the best companies in the world, I just had too many ETFs, too many holdings that were overlapping in my portfolio. Therefore, I made the decision to sell off the majority of this holding. And lastly on the list, maybe some of your favorite coffee out there, Starbucks. Had to let that one go. To be honest, this is just a company that I have not been that happy with while holding it. PE is about 30 right now. Taking a look at the balance section, they're in debt, $8.32 billion. Not really something you want to see. Their payout ratio for their dividend is 60%. Again, I think that's very high for the kind of companies that I want to own. Taking a look at the free cash flow, dismal performance in my opinion. We can see that last year they made $3.68 billion. They paid out their executives $302 million, which isn't that bad in my opinion, but the free cash flow in general is just very cyclical. You can't rely on it to continually go up year after year. So I think that's something that this company needs to work on. Compare that free cash flow to their revenue, and they're painting two different stories entirely. If this is what the free cash flow looked like, believe me, I would buy this stock all day long. But that's exactly why you have to compare the revenue to the free cash flow, how much this company is actually making. Taking a look at the cash to debt ratio, we can see that the capital leases makes up a sizable amount of their debts. Now, typically I would push this aside, but for a company like Starbucks, I think it is important to include this into the overall calculations, because make no mistake about it, they have to pay for these stores. It's a huge expense for them. There are Starbucks all over. So for this company, I do keep it included, and I think it's something that they need to get a hold on. Compare the debts to the cash. We can see that the cash is going down from 2021 to 2022 and a slight rise in 2023. It's just not predictable. For any current Starbucks shareholders out there, I'm not saying that this company is not a buy. It has a lot of great qualities that I think people overlook. One of those qualities being they are buying back their own shares. Again, this is artificially increasing the price of the stock, meaning that your portfolio goes up in value. Another great quality this company has is the return on capital employed. Last year, their return on capital employed was nearly 30%. So this company knows how to market itself. They know how to use money to make additional money. So this is something good to see. And there you have it. The reasons behind selling $40,000 worth of stock was to pay off some debts and to shift my investment strategy. Remember, everyone's financial journey is unique, and it's essential to tailor your decisions to your own circumstances. If you happen to miss it, I do have $6,000 in cash sitting in my account, and there is one company in particular, not just Visa, that I'm taking a look at, and I'm making a serious decision as to buying into this company. If you're interested to hear what that company is and you want to see a deep dive on it, let me know down in the comment section below. With that being said, that's going to conclude episode 15 of Road to 1 Million. If you guys have any questions for me, feel free to leave your questions down in the comment section. I get to them all. And if you want to stay up to date with the portfolio, what I'm buying in the future, don't forget to subscribe and leave a like if you found this video useful. I appreciate you guys tuning in. I'll see you in the next one. Take care.